Well, good morning. It is 11 o'clock, so we're going to start today's presentation by the lovely ladies from the Local Government Services Bureau, and the subject matter today is year-end closing. Super relevant topic. Reminder that we are going to either open up your mic or Darla will be reading your chat questions 2 times today. The first time will be after Carrie presents, which should be around 20 minutes. So you can have a little break, you can reflect on some of her presentation, and then go ahead and ask your question either by raising your hand. You just hover over your name, your hand will pop up. I'll go ahead and open your mic up. You can ask your questions, or you can just type it in the chat box. And we will be sure to get those questions answered. And then Tammy's going to present right after. And again, we'll open that portion up to questions when she's done presenting. So year-end closing, a wealth of information. The handouts I have put on the listserv, and then they are also on the extension, the education portal, so you should see them in there. And the quiz will open up at 1 o'clock. So let me know if you have any questions, email them to me. Thank you for joining us today. Thank you, ladies. And Carrie's going to be presenting first.
Thank you, Jane. Really? Okay. Tammy and I want to welcome you this morning, and just want to hope you're going to learn today what resources are available for your year-end closing, what some of the proper steps are to take to do your year-end close, and how to complete some of these year-end closing entries. Year-end closing should begin usually within 30 days of your fiscal year end, if not a little sooner. Most entities I know of usually have a mid-July cutoff date for processing their prior year entries. And if your accounting software happens to allow for period 13 or a month 13 transactions, you can use this, and this will help you track your year-end entries and make sure you're not missing any. It also makes it a little easier to find them. But if you don't have a period 13 or a month 13, I would suggest using a consistent date or labeling process for those year-end entries. Your entries are prepared according to GAAP, and this is going to assist in providing accurate financial information for your statements. And this process will also be part of your internal controls, which your auditors love to look at. We do have a checklist on our website, the locations noted here on this slide. And it follows, again, a logical process for completing your year end. It also provides information on the differences in the steps necessary to close your governmental funds, on a modified accrual basis, or your proprietary funds on the full accrual basis. I just want to make a short note here. We do have a new small government financial reporting framework this year, and if you've been accepted, you've applied and accepted to use that, your year-end process may be slightly different, but it shouldn't be that much different in following these steps. Some of the changes in that reporting, the small government reporting framework, are there's no government-wide statements prepared. There's no GASB 73 reporting, but there are new schedules for your governmental funds, capital assets, and long-term obligations. And I think Tammy will touch a little bit more on that later in the presentation, and we'll be touching on that in our AFR annual financial report presentation in a couple weeks. So again, our website has a checklist, and it's just a good handy reminder of the areas that you should be looking at when you do your year-end close. I'm going to talk about the first 4 sections here today, and Tammy will be finishing up. The instructions or the checklist on our website has some good detailed information on how to complete these entries. And at this point, I'm probably going to repeat this little bit of information once or twice, probably throughout this, but I would suggest at this time going ahead and printing that checklist and keeping files or um, keeping all this information in one spot so you have it handy and you can find it quickly. Plus, it'll aid in your next year's year-end close when you're looking to see which transactions you're going to need to do and which areas you want to look at. So one of the first steps in doing your year-end close should be to review your trial balance. You want to look at all funds and all your accounts. And again, just a reminder of our accounting 101. I don't know about most of you, but it's been a while for me. Asset accounts, your deferred inflow of resource accounts, and your expense or expenditure accounts should be maintaining debit balances. Your deferred outflow of resource, your liability accounts, and your expense and your revenue accounts should all be maintaining credit balances. So when you're reviewing your trial balance and you don't see these types of balances in the accounts, go ahead and get it researched, prepare any adjusting or correcting entries if you need to, and make sure you're getting posted to the correct fiscal year. There may be also a legitimate reason to have an opposite balance than what you would normally expect. And this would be probably your contra accounts. If you had a big change in your fair value of some of your investments. And then some of the factors which also may lead or create incorrect balances are if you've improperly coded a transaction, if you've missed posting a transaction, or if you've even posted one to an incorrect account. So here I have a sample from Black Mountain Software of a trial balance, and you can see kind of at a glance here, a couple asset accounts that don't have a correct balance and a liability account. And these are the ones you're gonna definitely wanna go and research and see why. And if it's legitimate, just at least understand why you have that kind of a balance there. Also part of your general review, you should be looking at your agency funds. You're reviewing those to see fund balance or net position, making sure that everything's been posted there as well. Your clearing funds should also be reviewed. Those are 7910 and 7930. And those funds or balances should equal your outstanding payroll, your claims items, and your due to others. Next, another area to be considerate of in your audit, in your general review, is your audit findings. If you happen to have an audit the prior year and if there were findings, make sure you've addressed those. If you had to post entries, make sure you've got those put in there. And then after your general review of your trial balance and looking at all those funds and accounts, you'll want to start in on your cash reconciliation. And here you're going to want to have your June 30 statements from the bank and also your investment accounts. And the balances in your software or books should balance to those statements. You'll want to reconcile all funds and even add a step to reconcile your total cash. Don't forget to do your petty cash account as well if you have one. If you have if there's expenses for prior year that need to be posted, get those done. And make sure your balances, within your statements are all tying out. Your investment accounts, the same thing. Make sure that you're tying out to those June 30 statements from those institutions. And finally, you want to look as well, make sure you don't have any negative cash balances. If you do, get some transactions done and posted so you eliminate those negative cash. Probably not a good thing to have at year end. So another area to look at here, as part of your cash recon, I would look at your pledged securities, and you want to make sure your financial institutions are holding the correct amounts for you. MCA says you have to have pledged securities for amounts not covered by insurance. And I've referenced the 2 sections here. And also, again, this is another area where you want to keep this information handy. It does feed into your notes for your financial statements. And again, touching on the investment accounts, do your reconciliation, and do you need to adjust for a gain or a loss? And this is another area where you want to keep all this information handy, because you're going to have to disclose your investment amounts and balances in your notes to your financial statements. So now I'm going to move on to reconciling receivables. There's quite a bit, or there's a few accounts in here that you'll really want to pay attention to. Of course, you want to look at all your receivable accounts, but you especially want to look at your taxes and assessments, all your other accounts receivables, your due from other governments, your due from other funds. And even though it's not a true receivable, you'll want to check your prepaid expense, and this is a good time to look at that. And this is also the time to make sure that you've posted all your prior year receivables. And those are the ones that were for services provided before your fiscal year end, but you have not yet received payment on. And again, make sure those are getting to the correct fiscal year. We do have a PDF formats of some past presentations on not only this year end close, but some of this the tax reconciliation and that sort of other related information on our website. And there is a worksheet available to do for doing your tax reconciliation. So we're going to start on that. And here you're going to make sure, and you're going to reconcile to the county report. And you want to reconcile your taxes and assessments receivable by fund, by individual years, and tax types. In your government, the one thing I'm showing here, these receivable balances should be equal to or compared to your deferred inflow of revenue tax accounts. And this will be in your governmental funds. Your business type funds or proprietary type funds don't have a deferred inflow of revenue account because the revenues are recognized when that receivable is created. So here on the right-hand side, or as I'm facing the screen, the right-hand side is just the name of our reconciliation worksheet for the taxes and assessments, which we're going to go over a few pieces of that here, just so you can see the name and the location of it from our training area. So the worksheet contains several tabs. This here is a sample section from the reconciliation by type tab. I'm just showing the real estate section because this does get rather long, but there are sections set up already for your mobile home tax, the personal tax, and the assessment receivable tax. Instructions for the sheet are towards the bottom, and there's extra reconciliation tables if you happen to need them. And you can see this is pretty straightforward for completion. Pretty much you just fill in what your software amount says for that, for the appropriate year and tax type, what the county report says and what their differences are, and how much of an adjustment you need to make in each of those years and to your deferred inflow. I just want to make a note here too, to say that make sure you're reconciling to the correct month of the county's report. For example, if you're going to receive May payments from the county into your software in June, you will be balancing to your May statements from the county. So that some other tabs on this in our template are the ability or the chance to calculate the amount of adjustments if you split your mill levy among various funds. And this can be used if when you receipt all your property tax into your general fund and then you split it after receipt. Again, this is pretty straightforward. You put in your tax year, you enter an adjustment amount in total if you have to adjust, and then enter your fund names and numbers and the mills, and it gives you the amount to use for your adjustment. The instructions for this tab are included at the top of the worksheet. And there's also tabs in there for splitting out personal property and mobile home taxes as well. The template also includes some journal voucher samples if you need to, if you'd like to have those for reference or just using and saving in your file that you're using for your year end. So special assessments, those should also be reviewed and reconciled, and this is the amount of your unbilled special assessments and SIDs. And you're going to reconcile to your amortization schedule of your assessment payers. And the receivable amount should be your unbilled amount as of 6/30 on that amortization schedule. And again, you want to compare the balance to your deferred inflow of resource specific account or related account for deferred special assessments. Another area to reconcile is your utility billing. You want to look at, you're going to reconcile to all your subsidiary records, which are either your individual balances or the customer detail reports. And you want to make sure and review also the delinquent accounts at this time. Make sure you don't need to do any adjustment for uncollectible accounts either. Your prepaid accounts receivable is another area to look at, and these are for payments made on services to be provided in the future. And if you have a material amount here, you'll want to show it as a liability rather than a reduction in the accounts receivable. Your due from other funds should also be reconciled, and those should balance to each other. Shouldn't have the same amount as you did in the prior year. And then if you don't expect these to be cleared up within 12 months, you'll want to create a long-term liability. And for those, you want to use the advances to and advances from accounts. And again, just mentioning prepaid expense, you'll want to make sure that you're carrying the correct balance at fiscal year end. And these are expenses that were paid in advance for receiving goods and services. Most common items here are insurance and maintenance agreements and possibly copier lease agreements and that sort of thing. And here you'll want to check. For example, if you entered into an agreement in April for a year, you want to make sure that you have 3 months of expense posted and the remaining balance as a prepaid. You want to look at your due from other governments. Did you do a grant reimbursement request in June, but you didn't get your funds by June 30? Make sure your balance there at due from is tying out to what your grant reimbursement request says. And then this is, again, another area where you want to have your supporting documentation available. And just kind of a recap on the taxes or accounts receivable. You want to make sure you're highlighting and looking at and making sure you're reconciling your taxes receivables, your deferred special assessments, utility billing, some of your due froms, your prepaid expense, your due from other governments, and make sure you're preparing and entering adjusting entries if necessary, and make sure you're getting them to the correct fiscal year. I just want to put out a thought out there for folks. And I know it's going to sound time consuming, but I would look at maybe getting some of these accounts reconciled, especially these receivables, on a quarterly basis. It's going to help you find errors. It's going to help you see if there's incorrect balances flowing through. Plus, it's going to make your year-end reconciliation not as long, or year-end closing not as long. If you do it quarterly, you'll only have 3 months of transactions probably to look at instead of 12. And then I would just include it as a step on the monthly cash recon when you do that for that quarter end date. So the last area I'm going to talk about here today is inventory. And this is an asset account and should carry a debit balance on your financials. You should do a physical inventory as close as possible to the end of your fiscal year. You need to adjust your statements, your financials, or your inventory accounts to balance to that physical inventory. And I know this is an area that can be troubling because it's hard to get folks, if you've assigned them to do inventory, hard to get some of that done and get your information back. And also, if you haven't done it in a year or two, it may seem overwhelming. I suggest just getting in there and getting it done, and it will help make your year end go a little easier there. So now I think Jane said we were going to take a quick break for questions, and we're going to turn this over to Tammy. So I want to thank everybody for their time this morning.
Thank you, Carrie. Yes, if you, excuse me, Darla's mic is open as well. So if you have a question, either raise your hand or go ahead and post it in the chat box. If you raise your hand, I will open up your mic for you so you can ask your question.
So nobody has any questions? Come on, somebody. Ask us a question.
Yes.
How many people are done with their fiscal year and closing entries? Raise your hand. Let's see how many are done. How many have started?
Oh, we got a couple of hand raises.
Sam started. Yay. Good job, Sam.
If you have questions, remember you can email us, or it's the easiest way to get a hold of us right now while we're working from home is to send us an email. You can leave a voicemail on our phone and we'll get a notice of it, and then we can call you back that way as well.
Samantha, I don't know if you are raising your hand or if you have a question. I opened your mic for you. Okay, so maybe just a hand raise. All right, well, I will go ahead and Tammy, where'd you go?
She ran away.
Okay, I'm here. Let me do my presenting. Okay, Jane, are you good? Can you turn the presenting over to me?
Yep. Trying to scroll my way.
Okay, I still can't see the share content yet.
Yeah, give me just 1 second. Oh, there it is. Okay. Not letting me scroll down. Okay, can you share now, Tam?
Nope, I'm not getting the little orange presenter across the. Oh, there it goes.
Okay.
Okay, we got it now. Okay, everybody see that? Okay. And I'm just going to do a little reminder, if you have your mic on, if you want to mute it, just so that we don't get that feedback. But I'm going to go ahead and start and talk about capital assets. And we're going to talk a bit about the basics of capital assets to start. GFOA defines capital assets as they either have to be used in operations, and they have to have an initial useful life in excess of 1 year for both tangible and intangible assets. Classes of different tangible assets include land, infrastructure, buildings and improvements, and machinery and equipment, such as vehicles and power equipment, or even office equipment. Intangible assets include non-physical items such as software, patents, trademarks, and copyrights. Most entities follow the federal government guidelines for capitalization thresholds. If your entity does not have a threshold policy for capital assets, one should be determined. You need to know when you make a purchase of an asset, what triggers that to become a capital asset and not just expensed. Typically, any asset purchased with a cost of $5,000 or more is capitalized as long as it also has a useful life of more than a year, and anything under that amount would be expensed. You can set higher thresholds for other classes of assets. The asset thresholds are included in page 26 of the notes section of your AFR. All right, costs to capitalize. The cost to acquire, construct, or improve a capital asset is not recognized immediately as an expense, but rather it's deferred or capitalized and allocated over the estimated useful life of the capital asset using the depreciation expense for tangible assets and/or amortization expense for intangible assets. Amortization and depreciation are two methods of calculating that value for capital assets over time, and amortization is spreading the intangible assets cost over that asset's useful life, where depreciation is expensing of an asset over its useful life. We can find more explanation of reporting of capital assets in GASB 34, as it was amended under GASB 72, but it's paragraph 18. And it states that capital assets should be reported at historical cost. The cost of a capital asset should include capitalized interest and ancillary charges necessary to place the asset into its intended location and condition for use. Ancillary charges include costs that are directly attributable to the asset acquisition, such as freight and transportation charges, site preparation costs, and professional fees. Donated capital assets should be reported at their estimated acquisition value at the time of acquisition, plus any of those ancillary charges, if there are any. And some of those can be your, like we said, your acquisition cost, legal and title fees, closing costs, appraisal negotiation fees, surveying fees, land preparation costs, demolition costs, audit and accounting fees, transportation charges, and interest incurred during acquisition. What it does not include are preliminary study or engineering costs, training employees to use the capital asset, and general or administrative costs. And now we're going to talk about additions in capital assets. There are differences in how you report capital assets depending on whether the assets were purchased using governmental funds or proprietary funds or the business type funds. However, depreciation schedules need to be kept and updated annually for all capital assets in order to be included on your government-wide statements. So governmental fund statements only record the expense of the purchase of the capital asset. And if you are using Fund 9000, the asset acquisition and the depreciation are then reported in the 9000 fund and listed on the GKEG worksheet for the government-wide statements. And you can see up above that you can, in additions to capital assets, you want to use that object code of 900 through 999 to determine that you have additions to your capital assets, in whichever account object code you assign to that. And then those are used for both your governmental funds and your proprietary funds, those object codes. But typically capital assets, if you're using Fund 900, those acquisition entries would be reported in that 9000 fund. Only the expenditure is recorded in the actual fund. So proprietary funds record the acquisition of the asset at the time of the purchase, and then it also records the depreciation expense of the asset using a straight line method over the useful life of the asset. And we'll talk more in depth about that in the next few slides. But capital assets, again, the difference there is that they are recorded as the expense and the acquisition of it at the same time. There's a couple of different scenarios that we'll talk about. If you need to expense the addition of a capital asset, you have to do a reversing entry at the end of the year to comply with GAAP. So additions in the governmental fund, let's go into a little more detail in that. Here's an example where we purchased a truck for $44,500 and we had $500 in transportation costs. And we can add that $500 transportation cost to the cost of the asset because it's an allowable cost for capitalization. So our overall cost is going to end up being the $45,000. So in the general fund, we're going to record the expense of the capital outlay, and we're going to use that 940 object code for $45,000. And then we're going to show the cash going out the door through the claims process for the credit to the $45,000. And then at the end of the year, we're going to do that adjustment to the 9,000 fund if you use the 9,000 fund. And we're going to record the actual equipment, the asset of the equipment. Machinery and equipment, we're going to debit for $45,000, and then we're going to credit the investment in capital assets. The capital outlay remains in the general fund, but the addition of the actual asset happens in that 9,000 fund, which then later will be reported on the government-wide statements. So now we're going to look at the addition of the same asset in the proprietary fund in the water fund. So we have, like I said before, we have a couple of different options here. Option one would be the GAAP compliant way, one entry, which is you're not going to record the capital outlay or the expense, but we're just going to show the acquisition of the asset. So we're going to show the machinery and equipment for $45,000 and then the cash going out the door for the purchase of the equipment. No adjustments are needed in this entry for year end. Option two, if we want to show the expense for budgetary purposes, say you have a department head that has a particular budget, monitors it religiously, and if we don't show that capital outlay coming against his overall appropriation, he could potentially see that he has an additional $45,000 to spend, which we know he really doesn't because he spent that when he purchased the truck. So you can show the expenditure for throughout the year to go against the budget for those budgetary purposes, and using again the 940 expenditure code, the capital outlay, and then the cash. If we do that, we're non-compliant with GAAP. So we do need to do a year-end adjusting entry where we go back in and we do the acquisition of the asset, the $45,000 to the machinery and equipment, and then we're going to reverse that expenditure. We're going to credit the expense and eliminate that expenditure entry so that we're in compliance with GAAP. So let's talk about what happens when we delete a capital asset. So there's different reasons we can get rid of a capital asset. We can sell it, trade it in, retire it, or we can also transfer it from one fund to another. We have to determine the carrying value of the asset, which is the original cost less any accumulated depreciation. And then we have to determine the gain or the loss. So if you sell the asset for more than the original cost, minus the accumulated depreciation, then you would record a gain. If you sell the asset for less than the original cost, minus accumulated depreciation, then you would record a loss on the sale. Remember, your debits have to equal your credits in the transaction to remove the capital asset from your books. We'll take a quick peek at some of those entries. So here's what that looks like. We have our original purchase price of $45,000, and it's not fully depreciated, and no cash was received when we got rid of this, this asset. So in the governmental funds under that 9,000, because remember, all we did in the general fund on the fund financial statements was expense the purchase of the asset. So now in the 9,000 fund, if you use one, we need to retire that asset. So the very last entry there, that credit, is going to be that offset to the asset, or getting rid of the asset, the machinery and equipment, for the full $45,000. Then we have to look at how much we depreciated that asset up to date. And so in this particular instance, we had $40,000 in depreciation. So we're going to remove that and we're going to debit allowance for depreciation for the $40,000. And then we're going to record the, I believe it's a gain on the sale of it, because we only depreciated it $40,000, but it has a $45,000 value. So we're going to record an investment in capital assets for the $5,000 for the difference. Our debits have to equal our credits. I'm sorry, it's a loss on the disposal of the asset. I got confused there. And it's going to be shown on the government-wide statements and adjusted in the GASB 34 conversion worksheets. So now let's take a look at the same transaction under the water fund, under the proprietary or business type fund. So we're going to do the same thing, only we're going to record the a loss on the sale for the disposal of the asset. So we're going to do the $40,000, remove the depreciation. We're going to credit the asset and remove it from the machinery and equipment. And then we're going to record that loss on the sale of the disposal of the asset, because it was not fully depreciated. All right, depreciation. What is depreciation? Depreciation is recognizing the cost of a capital asset over time, the useful life of the asset, versus just showing a one-time large payment expensed for the purchase of it all at one time. Tangible assets are depreciated over their useful life. Using a straight line depreciation takes the cost of the tangible asset and divides it by the useful life time frame. So it's typically in months. So example, for 5 years of a useful life, you would take the cost of the asset and divide it by 60 months to come up with the monthly depreciation amount. Intangible assets are amortized over their useful life, and amortization can sometimes include both principal and interest amounts if it applies. So there are a couple of situations where you do not recognize depreciation of a capital asset. The first one is indefinite useful life. An example of that would be land. Sometimes there's no expiration date on land. So we're not going to depreciate that. Another example would be like a heritage item, something that is invaluables, where you can't put an actual replacement cost on it. If it's a historical item, and if it was to be damaged, there's really no value that you can put on replacing that. So then again, we can't figure out what a depreciation amount would be for that. So we're not going to depreciate that. The second one is the construction in progress, sometimes referred to as CWIP, or construction work in progress. If we were to depreciate construction in progress before that capital asset was completed, we would be double depreciating it. You'd be depreciating it while it's still forming and being constructed. And then once it's completed and capitalized, you'd be re-depreciating it. So we're not going to recognize depreciation on anything that's in progress. Only once it's completed and capitalized completely will we start depreciating. All right. So depreciation schedules and the importance of depreciation schedules. It's highly recommended that you keep it current. There's nothing harder than having to go back and try to reconcile a depreciation schedule. It's easier to do it current, real time, and keep it up to date. Make sure that you're removing any of those deleted assets from your schedule, and then also make sure that you're adding anything that you've added recently to your schedules. Keep those schedules up to date. Those are going to contain your cost, your description, or your acquisition date, and the estimated useful life. The number of depreciation schedules depends on the number of your proprietary funds. So you're going to maintain one depreciation schedule for all of your governmental funds, because again, the only time we're going to be using that is for those government-wide statements. But you do need to maintain a schedule for each of your proprietary funds. So that's going to depend on how many proprietary funds you have as to how many different depreciation schedules you can have for your business funds. Our annual financial report template does have sample depreciation schedules if you need one. Most people have their own, but we do provide one in the AFR in case you need one. It's a very nice laid out schedule. And there's one for each the governmental fund and then each of the proprietary funds as needed. So any capital asset with the limited useful life that meets your entity's specific monetary thresholds for capitalization must be depreciated, unless it meets the definition of a non-depreciable asset, such as that land or construction in progress. So it's best to determine the useful life of the capital asset based on your own government's experience. How long do you typically keep the type of asset in service? For example, if you are replacing a utility service truck about every 7 years, you would consider using 7 years for your depreciation instead of 5. And the same could be said if you're replacing the truck every 4 years. You could want to shorten that depreciation to 48 months versus the full 60 months, since the vehicle would not be fully depreciated at the time you planned to replace it. Larger assets, such as buildings, would have longer depreciation timeframes, spreading out the larger cost over a more comparable useful life. Again, that's all determined by your governing body. So now let's move on and talk about short-term payables. These are your accounts payable, your accrued payroll payables, and your accrued interest payables. And they're liabilities for goods or services received for which an expenditure or expense has not been paid at year end. So the basic rule is a government should accrue a governmental fund liability and expense in the periods in which the government incurs the liability. Salaries, professional services, supplies, utilities, travel, and similar items are recognized as expenditures in the periods in which the government receives the goods or service. For business type funds, they follow that same concept for that accrual basis of accounting. Of course, there are always exceptions for certain items such as debt service, pensions, OPEB, and inventories of supplies and prepaids. Payroll that overlaps in a new fiscal year also needs to be accrued to record the proper expense in the proper reporting period. The same concept applies for interest payable as well. Any expense that is incurred in the current fiscal year but will not actually be expensed and paid until the next fiscal year should be accrued and a payable set up to be satisfied when the cash transaction actually takes place in the next fiscal year timeframe. It's important to be consistent from year to year. If you are unsure about an entry, look back and see how it was handled in the previous fiscal year. Review your previous year-end JVs to make sure that you are processing all the activity the same way, if it still applies. For grant reimbursements, make sure to recognize the expense and revenue in the same accounting period by setting up that due from other governments for any requested reimbursements that won't be received until the new fiscal year. Once the cash transaction is made, then you would offset that due from to record that reimbursement when the cash is received. But we want to recognize that revenue in the same time period that the expense happened. So even though we're not getting the actual revenue in that particular fiscal year, we're going to set up that due from other governments, and that'll be that placeholder until the next fiscal year when the cash actually comes in. Then all we have to do is receipt in the cash and reverse the due from other governments. So now let's talk about long-term obligations. Long-term obligations are due in more than 1 year. However, we do have a current portion of a long-term obligation and then the actual remaining long-term obligation. So some examples of those are your long-term debt, loans, notes, bonds, leases, your compensated absences, your pension liability, and your other post-employment benefits if you do record that. And we do have training and templates available on our website for those. And most of these items have a current long-term portion, like I said, and the remaining longer amount. So that being said, at year end, we need to adjust the current portion and the long-term portion. As another year goes by, those amounts need to be adjusted to make sure the totals are up to date and current for your fiscal year end. So when debt payments are made, they are usually processed in your voucher system. There are liabilities recorded that may need to be adjusted for the principal payments that have been made throughout the fiscal year. In a governmental fund level statement, only the interest is recognized as an expense. Adjustments will need to be made to compensated absences based on current leave balances and pension liabilities based on the current Impera statement actuary information that you receive. And also the OPEB liability will need to be adjusted if applicable. It's very helpful to have a fiscal year end checklist to make sure that you are reviewing all the balances that pertain to your particular entity. So let's talk about debt in the governmental funds. So again, long-term debts are not reported in the fund level statements. They are reported on the government-wide statements. So proceeds from new debt are receipted into the fund level statements. Long-term debt payments are shown in the funds using those expenditure codes 610 through 619 for principal and 620 through 629 for interest. And if you are using Fund 9500 for your long-term obligations, you can use the GLITTAG form in the annual financial report in our Excel version from our website if you need to. And this form tracks the obligations for all of those governmental funds. It is not used for the proprietary funds, only the governmental funds. Also remember that when a long-term obligation is forgiven, it must be recognized as revenue in the reporting period it is forgiven. I've seen it where people forget to recognize that revenue, and it does, a lot of times that can change your filing your revenues, and sometimes that's caught by auditors and then we have to go back and make that correction. So remember, if you have long-term obligations and that debt is forgiven, it has to be recognized as revenue. All right, debt in the proprietary fund. So that is also reported at the fund level statements, and the proceeds from new debt is increased in the outstanding loan, note, bond balances for the debt in the account number. Or not the debt account number. So long-term debt payments are shown in the funds using the outstanding balance accounts listed above. And again, you're going to use that object code 610 through 619 for principal and the 620 through 629 for the interest. And if the debt proceeds are receipted or coded as proceeds, a journal entry needs to be done to reverse the proceeds and increase the outstanding balance. So again, if you're doing that for budgetary purposes, you'll have to reverse that. If you have coded principal payments as an expense, a journal voucher needs to be prepared at year end to reverse that expense and reduce the outstanding principal balance. And interest payments are treated as an expense, same as in the governmental funds. It is a good practice to review your outstanding statements from the lender to make any adjusting entries that need to be done to shore up the principal and interest amounts to balance your system to the actual statements. Keeping track of this now can save you balancing issues when the debt is satisfied in later years. And again, make sure you are reviewing bond covenant requirements for restricted cash balances as well. You may need to make an additional entry to adjust your restricted cash to be in compliance with the amount required in the bond covenant. This could be an audit finding if it's not properly monitored. And that would be an offset to your restricted cash and your restricted fund balance. All right, moving on to compensated absences. So we're going to start by running our payroll report showing the sick and vacation leave balances as of the end of our fiscal year, which is that June 30 date. It's important that you remember to use that year-end June 30 date. A vacation leave is calculated using 100% of the balance, and sick leave is calculated using 25% of the balance. And the allocations should be based on how you allocate your payroll. And we have a spreadsheet for calculating that, again, in the AFR template if you need it. I'm going to show you an example of it in the next slide, but it's there for your use as needed. The calculation of the compensated absences should be completed using the same allocation as your payroll. I can't stress that enough. And we're going to take a look at the example. Keep in mind that for our visualization purposes, we hid some columns in this spreadsheet. There are hidden columns at the end there where it says the general governmental funds, the water. There are other columns for sewer and solid waste as well. But just for visualization's sake, we took those out so that it wasn't microscopic, but they are there. And then you can also use whatever adjusting percentages, you can change those formulas to adjust to whatever percentages you find necessary. So depending on whether the allocation increases or decreases from year to year in the individual funds is whether the adjustment will be a credit or a debit to the long-term obligation account, that 239000 for your compensated absences. This particular example, all of the balances were increasing. You can see there the prior year amounts were less than what is currently being calculated. So we need those adjustments to bump up our compensated absences liability. So in that particular example, in order to increase that liability, we need to credit the amounts shown for that difference in order to get our total balances up to where they need to be. And then you would use the 239000 compensated absences and the 174300 for the fund 9500. Again, remember, this is not going to be reported on your general fund level statements. However, we're doing this for the government-wide statements. And the business type funds will also be reporting these amounts. And you can use those in those function expense codes, object codes 195 through 199, whichever you have designated for the compensated absence purpose. All right, on to our favorite topic, that net pension liability. So net pension liability, the local governments that are participating in IMPERA report their share of the pension liability expense at year end in accordance with GASB 68. Annual adjustments are required for the net pension liability, and they include the deferred outflows and deferred inflows, and the pension expense, as well as those on behalf revenues. So we have a spreadsheet out there on our website called Net Pension Liability GASB 68 worksheet. It's a very intricate spreadsheet, but it calculates it out and it provides really good information for making your entries. So on the right-hand column of the slide, we're going to talk about all of the different things that you will need in order to fill out the GASB 68 worksheet. So you're going to need those notes provided by IMPERA, and that's on their website under their GASB information tab on the right-hand side of their website. You need to ensure that you download all of the required plan notes that you need. So if you have sheriff's retirement, if you have firefighters, if you have the MPORs, municipal police, all of those, you need to download all of those, and because you're going to have to fill out one for each of those different plans. The teacher's requirement system also has it on their website for their information. And then we have the website to calculate that all out on our website, GASB 68. It is listed under the annual financial report resources in that list of where you'd find the AFR template. It's listed in that under that. So the adjustments to the net pension liability are calculated by Impera and their actuaries. However, it needs to be broken out per fund type based on your payroll allocations. The net pension liability information provided by Impera does not need to be included in your AFR if you have opted to use the small government framework reporting. However, the RSI, the required supplementary information pages from the Impera statements, are required for both the full GAAP and the small government reporting. So we have provided a net pension liability GASB 68 worksheet again to help calculate that, and we're going to be going over that in the next few slides. So net pension liability GASB 68 worksheet template. Step 1 is to download those Impera reports and have those handy. Step 2 is on the PERS deferred schedule tab. You're going to need last year's calculation in order to update those prior year columns. And then you're going to, again, need this year's Impera statements to update your current year information based on your ER contributions. It's important to use the actual prior year employer contributions made in order to calculate the proper adjustment needed in your software system for your current year's liability. And I'm going to talk a little bit too about once you get this statement, this worksheet filled out, if you want a second set of eyes and you want us just to review it to see if everything's been entered appropriately, you know, everybody's human. People can sometimes make mistakes. Sometimes it's good to have a second set of eyes. If you want to send that to one of us, we'll be more than happy to review it, just to look it over. If you do that, please send us the prior year spreadsheet as well so that we can verify those beginning balances that are reported as the prior year plan disclosures. But again, we're more than happy to help review that just to make sure that it's as accurate as it can be. So on to step 3. We need to complete the sample JV tab from the Impera statement. That is typically found at the very end of that Impera report. And one thing to keep in mind is you're going to input into all of those highlighted yellow cells. The salmon colored cells are formulas. You do not need to enter information into those, just those yellow cells. And you will need your current year employer contributions from the ERIC system to enter into number 3 there at the bottom. Note that each of these deferred resources has both an outflow and an inflow line to choose based on the adjustment amount going up or down on the sample JV entries. So you will only fill in one or the other for each category. So I've seen people mistakenly just kind of group them all together or put both a debit and a credit on the same entry, and you can't have both. It's either one or the other. So if you want us to just review that, we can do that as well. But make sure that you're looking at the exact wording of what you're inputting, the information that you're inputting. Read the lines carefully because Impera has a habit of switching up the order of their reports. And so where you're typically, sometimes you're used to it being on one particular line and you just enter it into the spreadsheet, you could be entering it into a wrong field just because they've changed the order of their statements. So make sure you're reading exactly what information needs to go where on that GASB 68 worksheet. And again, you're going to need to fill in this information separately for each retirement system. So we do have a tab for FERS, MPORS, sheriff's retirement, and teachers. Next, in step 4 is the payroll allocation tab. On the payroll allocation tab, you need to make sure you're using the totals for only the employees participating in the PERS plan. So don't include any temporary or seasonal people that are not paying into the retirement. This is only people that are paying into it. And this is where we will break out the amounts per fund. So you can use your total overall payroll allocation from your software system, or you can use the specific contributions per fund to the system to allocate for the totals, whichever you prefer. You can do it either way. Make sure to complete the form by breaking out the amounts per the major function on the bottom section. Moving on to step 5 is completing that net pension liability on that recap tab. So the prior fiscal year ending balances should be the same as what was reported on your prior year annual financial report and what is currently in your trial balance in your software system. And before you make these adjustments, make sure you're verifying those totals are correct. If you had audit adjustments or any kind of adjustments that happened after your AFR, you want to make sure that you're using the right prior year totals so that when you're calculating your current year adjustment amount and you put it into your software, you're ending up with the exact balances that you need that were calculated. So it's very important to make sure that your balances for the prior year are the same as what you previously reported. And you want to make sure that your current year liability is what your software system will reflect after you make those appropriate adjustment entries. All right, step 6. Governmental funds, the entries and the adjustments. The governmental fund adjustments tab is where you will get your information for your adjusting entries and information for your GLIT tag, BS and OP conversion worksheets, and your revenue analysis worksheet. You're going to need that on behalf amount to put in your revenue analysis worksheet. The worksheet and instructions help you determine the debits and the credits and how to incorporate the amounts into your AFR. So as a reminder, revenues are a credit and expenses are a debit. And to increase a liability, you need a credit. To decrease it, you need a debit. To increase an asset, you need a debit. And to decrease an asset, you need a credit. Just a little accounting 101, something to keep in mind when you're making those adjustments. And then for the step 7, the business type proprietary funds tab. The proprietary fund journal adjust tab is for the adjustments to your business type funds as appropriate to your specific entity. So if you only have water and sewer, you're only going to do account codes for those. If you do have all 3, water, sewer, and solid waste, there's space for those as well. In the end, you want to make sure, again, that your total long-term obligations for your pension liability calculated on the spreadsheet match your ending balances in your software system after you make your year-end adjusting entries. So pull a trial balance and verify the beginning totals, do the adjusted journal entries, and then pull another trial balance to make sure it matches the amount you're entering on your GLIT tag or the amounts that you're expecting to see in your business type funds. Because in the end, these transactions, you want them to increase or decrease your net pension liability to the proper amount. So step 8 is that required supplementary information in the AFR. Impera provides the RSI schedule of net pension liability and notes to the RSI. And you can use the information obtained from the Impera ERIC system to complete the schedules in the template if you're using our AFR template as needed. You do not have to use the Local Government Services Bureau template. It's there for your convenience as needed. You can use the notes to the RSI to fill out the AFR template tabs for pages those pages 61A through E. There's one there for the Impera, and there's one for FERS, IMPORs, teachers, and sheriffs. So there's a tab for each of those. I highly recommend, if you don't have other retirement systems, if all you have are either PERS and or IMPORs, but you don't use FERS or teachers or sheriffs, I highly recommend that you hide those tabs if you're using our template. You don't want to be presenting a bunch of blank statements to the readers of your document, because all it's going to do is confuse them, and they're probably going to wonder why you didn't fill it out. So if you're not going to use it, it does help decrease the size of your document when you turn it into a PDF. So any of those statements that you're not using, just go ahead and hide those. You don't need them, don't delete them, just hide them. And then also on the worksheet, there is a tab for the PERS note. It's an optional tab. You do not have to complete it and include it in your annual financial report. It's just there as needed. You do have to fill it out. There are blank sections in it. You'll use those Impera statements that are provided to input the information. And then there's an instruction tab that you can use to convert it to a PDF format and then insert it into the notes section of your AFR. And you can copy and paste those required supplementary information notes out of those Impera statements right into your AFR if you want to as well. Moving on to GASB 73 reporting. So GASB 73 is applicable to pensions and related assets not within the scope of GASB 68. So it applies to most fire department relief associations because the assets are not held in trust or an equivalent arrangement, and the pension liability expense are reported similar to GASB 68, and an actuary valuation is required every 2 years. So the liability may or may not be material. You should check with your auditor annually on that. The MCA code that goes along with this is the 1918-503 MCA to soundly fund the FDRA. It's related, but not the same as GASB 73. Compliance with the MCA does not constitute compliance with GASB 73 reporting. If the FDRA does not provide benefits, GASB 73 likely will not apply. You won't have to worry about it. So if you have an FDRA and you are following the MCA 1918-503 to soundly fund your FDRA, your governing body may determine that the cost of the actuary to fulfill the requirement of GASB 73 is not financially prudent, and they're allowed to do that. However, per GAAP, you are required to follow GASB 73, and you may receive an audit finding if you are not in compliance with GASB 73. Some entities I know have chosen to follow MCA and keep the fund soundly funded and report as their audit response the reason that they do not do the actuary, if they do receive that finding. So OPEB reporting, other post-employment benefits. OPEB reporting applies to benefits other than pensions, such as group health benefits. And you have to do the reporting. It applies if your healthcare benefits are offered to retirees, and a single or blended premium is used for both your active and your retired employees, because then there's an implicit rate subsidy that is involved. The change in the proportionate share of the OPEB liability is adjusted annually. And the information may come from your insurance carrier. If you use MMIA, you can get that information from them. The alternative measurement method and/or an actuarial valuation. Adjustments are done in each proprietary fund and the GLTEG for the governmental funds. Because again, those are not going to be reported in your government fund level statements, only the government-wide statements. And we do have FAQs on our website, and the other resource would be GASB 45 and GASB 75. Make sure you are, as applicable, making the adjustments for OPEB for the other post-employment benefits that your entity offers. The adjustments to OPEB are made just like the compensated absences and pension liability adjustments. Make sure to update the deferred inflows and outflows according to the calculated adjustments. The Local Government Services Bureau Annual Financial Report template was updated last year to reflect individual lines on the BS conversion worksheet for the OPEB liability and the deferred inflows and outflows. Previously, it was just one line. We've now split that out so that we can track all of those individually. Makes it a little easier to follow. And then again, make sure you are including the adjustments on your GLTIG for the governmental funds. Now let's talk about some other considerations to follow for your year-end adjustments. So transfers between funds, Carrie mentioned this in the first part of the presentation. Transfers in have to equal transfers out. You're due to other funds equal you're due from other funds. Those are things that you have to take a look at. Your revenues, review your receipts of governmental revenues and make sure that you have all of the proper entries made. If you have 12, you should have 12 gas payments per year. You should have 4 quarterly state entitlement payments. Make sure that you're counting those up and make sure that you have all of the proper payments recorded. Review the fund balance classifications per GASB 54. Again, that kind of ties back to some of those bond covenants. If you need to make those adjustments for the bond covenants to your restricted cash accounts, that is something to look at as well. The general fund has the unassigned fund balance. There are other, if you have prepaids or inventory fund balance restrictions, you sometimes will need to evaluate those and make sure that those are properly being reported. You might have to make some adjustments to those as well. It's a good idea to keep your prior year adjustment journals handy and refer to them as your current, as well as with your current year checklist to make sure that you are including all of your needed year-end adjustments, transfers, due to, due froms, etc. Be mindful of auditor recommendations or findings where corrections were made to your adjustments to prevent making that same mistake by just following your previous year's entries. If you made an adjusting entry and maybe it wasn't accurate and your auditor came in and made the recommendation to fix the entry, make sure that you're using that fix and not just continuing to make the entry as it was before where it's been updated and fixed. Some other things to be mindful of are debt payments that are no longer needed. Maybe your debt's been satisfied, entries, and then look for entries of new debt that has been acquired to make sure that all of those are being reported. Any retired assets that need to be removed from your depreciation entry and or your depreciation schedules, and any entries that need to be added for new capital assets that are added to your depreciation schedules. Look for any new agreements between funds for loans or transfers that need to be made. The due to, due from between funds needs to balance out, as well as the transfer in and transfer out between funds. Run a report to make sure that they're equal. And then again, I can't stress it enough, check your bond covenants, make sure that that's being reported accurately as well. To look at. This is an important one. Review your budget to actual reports to determine if a budget amendment is necessary. It's very important to make sure that if you're over budget, you need to hold a budget amendment hearing. Again, that's per fund, not line item. It's per fund. And also look to see if there's significant variances in your budget to actuals. Maybe there's something that was coded incorrectly If it looks odd that you haven't spent the amount of budget that you anticipated, you might need to do a little bit more research just to make sure and figure out why there's that variance. And then do your beginning fund balances and net position match to your last year's AFR audit. That's another one to check as well. Do you need to make any prior year adjustments? And do you need an audit? Revenues greater than $750,000. Does it need to be a federal audit? Is your revenue in excess of 750 partially due to federal funds? And then definitely check this out prior to contracting with an auditor. Make sure you are expending the appropriate annual payments in each fiscal year. Do not process an upcoming year's subscription at the end of a fiscal year if you processed last year's at the beginning of the fiscal year. You want to keep it equitable. You want to make sure that you're recording those in the proper fiscal year. And verify that all the expected payments have been made in the appropriate fiscal year. Completing your annual financial report as soon as possible after you are sure all of your year-end adjusting entries have been completed will help you find errors you can get corrected sooner rather than later. This will also help identify any prior period adjustments that you need and verify any audit adjustments that have been made in your software system. If you had previous year audit adjustments, it's extremely important to make sure that you verify that those have been included in your software. Our next scheduled training is, like Carrie mentioned, is going to be on completing that AFR. I believe it's on the 18th of August. And at the time, we will also be discussing that new small government financial reporting framework for the annual financial reports. We'll go into a little more detail on that. And doing your annual financial report will aid your auditor in completing a required audit and may save you money on the actual audit costs. Auditors that do not have an AFR to refer to have to spend additional time and effort to verify the information in their audit report. If you wait to turn in your audit in lieu of an AFR, remember that the audit itself will not satisfy your entire annual financial report requirement. You still have to submit with the audit your other supplementary information required, such as your intergovernmental revenue schedule, cash receipts and disbursements, and your cash reconciliation. Your annual to other entities' annual financial report. That's why we require everybody to submit the same required information. And that actually completes the presentation. So now we're ready for questions.
That was a lot of information. Honestly, I'm constantly amazed at the information, the help that you guys provide, the fact that you are so willing to have people review any paperwork that they send your way. It's just absolutely amazing. So Darla is on to answer questions. Carrie, Tammy, you can ask away either by entering into the chat box or again raising your hand. And Darla, did you want to add anything?
Just if anyone has any questions, remember to just email us. If you need assistance with your fiscal year end closing, we're available to provide assistance. We have resources on our website as well, but if you have questions, don't hesitate to contact one of us.
And we will be seeing you in in a couple of weeks. So just a reminder that Tuesday, August 18th, Buffalo Government Services Bureau will be back presenting on annual financial reporting. So that's Tuesday, August 18th at 11 a.m. Right, well, I do not see any questions. So I think we will end the, Tammy, and Keely and Darla, thank you so much.
Thank you.
And have a great rest of your week.
Thanks. You do the same, Jane.
Okay, bye-bye.